John D. Rockefeller once said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." Whether you agree or not, you can't blame Rockefeller for being excited about his dividend income. It's a powerful tool for compounding wealth over the long term. One great way to earn passive dividend that doesn't require constant grind or waiting until you're gray and wrinkled to enjoy the fruits of your labor is dividend investing. So then the question becomes, how can we make use of this amazing wealth-building tool to earn a monthly payout of $5,000? Stick around, because we are going to reveal 5 best and most effective strategies to get to that goal. First, let's understand what dividends are, how they work, and why they are crucial for achieving financial independence. Dividends are one of the best ways of making money while you sleep. So how do they work? Well, when you buy shares of a company and invest in its stocks, you become a partial owner. If the company makes profits, it can choose to either reinvest the profit to grow the company or share those profits with you, the shareholder, in the form of dividends. As the shareholder, you will receive a portion of that profit based on how many shares you own. Companies have different schedules for paying dividends, often quarterly, after 3 months for most companies, but some do it monthly or annually. They can be received as cash either through a check or digital deposit, or you can decide to reinvest yours in more shares of the company's stocks. Now, not all companies pay dividends, but those that do can provide a steady stream of income for you as an investor. One key metric to consider when investing in dividend-paying stocks is the dividend yield. It provides insight into the income generated from investors' investments relative to the stock price. Essentially, it represents the percentage return an investor can expect to receive from dividends based on the current market price of the stock, which calculated by dividing the last 12 months of dividends per share by the current share price. It fluctuates with the market. A higher dividend yield indicates a higher proportion of income relative to the stock price, making it more attractive for income-seeking investors. However, it's important to note that a high dividend yield doesn't always equate to a good investment, as it could be a result of a declining stock price or an unsustainable dividend payout ratio. Conversely, a low dividend yield may suggest a company reinvesting profits for growth or potential undervaluation. For example, if a stock pays an annual dividend of $2 per share and its current price is $50 per share, the dividend yield would be 4%. The higher the dividend yield, the more income you'll receive for each dollar invested. Now that we understand the basics, let's explore some strategies that can help you earn $5,000 a month in dividends. 1. Covered call ETFs. Covered call ETFs are an intriguing option for investors seeking consistent income with a bit of downside protection. Here's how they work. These ETFs typically hold a diversified basket of stocks and then sell call options against those stocks. What are call options? They are financial contracts that give the buyer the right, but not the obligation, to purchase a specific asset, such as stocks, at a predetermined price, the strike price, within a specified period of time, until the expiration date. When an investor sells a call option, they receive a premium payment from the buyer in exchange for granting them the right to buy the underlying asset at the agreed-upon price. In the context of covered call ETFs, the ETF holds a basket of stocks, and the fund manager sells call options against those stocks, allowing them to earn extra income in the form of option premiums. If the stock price remains below the strike price by the expiration date, you keep the premium and can sell another call option for additional income. However, if the stock price rises above the strike price, you might have to sell your shares at the agreed-upon price, limiting your potential for capital appreciation. In a nutshell, the strategy of selling covered calls can enhance the yield of the ETF, but you might cap your potential for capital appreciation if the stocks in the ETF experience significant price changes. However, for income-focused investors, this trade-off might be worth it. This can boost your overall yield, making covered call ETFs an attractive option for income-focused investors. A prime example is the Invesco S&P 500 Buy-Right ETF. This ETF tracks the performance of the CBOE S&P 500 Buy-Right Index, which involves holding a portfolio of S&P 500 stocks and selling covered call options on those stocks. Investors benefit from the income generated by selling options while still participating in the potential upside of the underlying stocks. So, how much do you need to invest for covered call ETFs to generate $5,000 per month? Assuming an average dividend yield of 10% for the covered call ETF, an investment of approximately $50,000 is necessary for a covered call ETF with a 10% yield to generate $5,000 per month in dividends. This shows the importance of understanding the dividend yield of a chosen ETF and aligning it with income goals, providing clarity on the investment amount required to meet specific financial targets through this strategy. 2. Blue-chip dividend stocks. Blue-chip companies are well-established, financially stable firms with a history of consistent performance, strong balance sheets, and dividend payments. These companies are typically industry leaders with a long track record of profitability, dividend growth, and ability to weather economic downturns. Companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola are classic examples, as these companies have established themselves with strong cash flows and a history of consistently increasing dividends, making them attractive choices for income-oriented investors seeking stability and reliability in their portfolios. Investing in a blue-chip portfolio of dividend stocks can provide a reliable source of income over the long term. Also, these stocks often have lower dividend yields compared to riskier assets, but they come with less volatility and more dependable dividends. So, when selecting blue-chip stocks, look for companies with strong fundamentals, including steady earnings growth, manageable debt levels, and a history of increasing dividends. These companies typically offer dividend yields in the range of 2% to 4%, although there are exceptions on both ends of the spectrum. So, how much do you need to invest in blue-chip stocks to generate $5,000 per month? Let's say a company is giving an average dividend yield of 3% for their blue-chip stocks. You'd need to invest approximately $166,667 in blue-chip dividend stocks with a 3% yield to generate $5,000 per month in dividends. While this initial investment might appear substantial, blue-chip stocks offer stability and reliability, making them a favored choice for income-focused investors. Additionally, their consistent dividend payments can provide a reliable income stream even during market downturns, making them an attractive option for building a dividend portfolio aimed at sustaining a monthly income. 3. Dividend growth stocks. Dividend growth stocks are companies that consistently increase their dividend payouts to shareholders over time. While these companies may not initially offer the highest dividend yields, they have the potential for significant dividend growth in the future, providing you with a growing stream of income. Investing in dividend growth stocks requires a long-term perspective. You're not just focused on the current yield, but also on the company's ability to increase its dividends year after year. Look for companies with strong fundamentals, stable cash flows, and a commitment to returning capital to shareholders through dividends. How much investment is needed for dividend growth stocks to generate $5,000 per month? Assuming an average dividend yield of 2% for dividend growth stocks, you would need to invest approximately $250,000 in dividend growth stocks with a 2% yield to generate $5,000 per month in dividends. While this yield might seem modest compared to other strategies, these companies have a track record of increasing their dividends by an average of 6% annually. Over time, this compounding effect can lead to substantial income growth. Also, the initial investment might seem moderate compared to other strategies, but dividend growth stocks offer the potential for increasing income over time, making them an attractive option for investors seeking long-term stability and income growth. One advantage of dividend growth stocks is their ability to provide a hedge against inflation. As companies increase their dividends, your income grows, helping to offset the rising cost of living. Also, dividend growth stocks tend to be less volatile than other dividend stock investments, providing stability during market downturns. 4. Dividend aristocrats. Dividend aristocrats are a select group of companies that have consistently increased their dividends for at least 25 consecutive years. These companies are often industry leaders, just like the blue-chip dividend stocks with strong competitive advantages and stable cash flows. Some great examples of these companies are Walgreens Boots Alliance Inc., 3M Company, and Realty Income Corp. Investing in dividend aristocrats can provide you with a reliable stream of income and the potential for long-term capital appreciation. Because of their impressive track record of dividend growth, dividend aristocrats are highly sought after by income-focused investors. These companies have demonstrated their commitment to returning capital to shareholders through thick and thin, making them a cornerstone of many dividend portfolios. So how much investment is needed for dividend aristocrats to generate $5,000 per month? Assuming an average dividend yield of 2.5% for dividend aristocrats, to achieve a monthly income of $5,000 solely from dividend aristocrats, an investment of around $200,000 would be necessary. Despite the seemingly lower initial investment compared to other strategies, dividend aristocrats provide a blend of stability and growth, supported by their consistent track record of increasing dividends for at least 25 consecutive years. This makes them an attractive option for investors seeking reliable income with the potential for dividend growth over time. One key advantage of dividend aristocrats is their ability to weather economic downturns. These companies have proven their resilience over time, continuing to increase their dividends even during challenging market conditions. By investing in dividend aristocrats, you can sleep soundly knowing that your income stream is secure, regardless of what the market throws your way. 5. High-yield REITs are companies that own, operate, or finance income-generating real estate across various sectors such as residential, commercial, or industrial properties. These trusts are required by law to distribute a significant portion of their income to shareholders, making them attractive options for income-seeking investors. The key advantage of invest is their typically high dividend yields compared to other dividend stocks. However, it's essential to note that high yields often come with higher risk levels, particularly in volatile market conditions or economic downturns. And how much should you invest in high-yield REITs to generate $5,000 per month in dividends? Assuming an average dividend yield of 7% for high-yield REITs, to achieve a monthly income of $5,000, an investment of around $71,429 would be necessary. While this initial investment may seem relatively lower compared to other strategies we've talked about, it's essential to acknowledge the associated risks inherent in real estate investments, such as interest rate fluctuations and property market conditions. Additionally, the liquidity of REIT investments may differ from traditional stocks and ETFs, requiring careful consideration of investment horizon and risk tolerance. Despite these challenges, high-yield REITs can be a compelling option for investors seeking higher income potential from their dividend investments, provided they conduct thorough research and maintain a diversified portfolio. Now that we've covered the strategies, let's talk about how to build a powerful dividend portfolio that can sustainably generate $5,000 per month. Building a powerful dividend portfolio is crucial for sustaining your $5,000 monthly income goal. Start by selecting quality dividend-paying stocks with a history of consistent payments, strong financials, and a competitive edge. Diversify your investments across different sectors to mitigate risks, ensuring your portfolio isn't overly reliant on any single company or industry. Embrace a long-term perspective, reinvesting dividends to leverage the power of compound growth. Always assess the risk associated with each investment, balancing potential returns with the underlying fundamentals. Regularly, monitor and adjust your portfolio to stay aligned with your financial goals and risk tolerance. By following these principles, you can build a robust dividend portfolio that not only provides a steady income but also grows over time, offering financial security and peace of mind. Want to multiply your income even more? This video on your right will enlighten you on the best compounding assets that are going to make you millions in just 5 years.